But there's three bubbles that we have that exist concurrently. We've never had three bubbles before exist at the same time. We have a real estate bubble, a massive real estate bubble. We have an equity bubble, and we have a credit. So he'll probably cut once or twice this year, Powell, depending on the repo market and when that reverse repo facility runs dry. Could be problems before then, but he'll cut rates ex post when it's too late, and then we'll probably have a very significant recession because of the three triumvirate bubbles existing concurrently. And then the Fed's going to cut rates to ZERP, and then the Treasury and the Fed will be monetizing helicopter money once again. And probably is going to be a prescription for stagflation as far as the eye can see. You're not going to have a mild recession where it's like a soft landing. No, you're going to have a recession that metastasizes into a depression. And I think they're going to have to go back to ZERP and QE. And that's going to have massive ramifications for inflation.
Mr. Michael Pento, thank you so much for coming on, my friend.
Danny, congratulations on the exponential growth of your channel, and I look forward to a great interview.
Excellent. Well, hey guys, before we get started, don't forget to hit that subscribe button. 85% of you guys who watch this channel are still not subscribed. Let's flip that ratio around, hit that subscribe button. And Michael, let's go ahead and kick it off. I ask this question to every new interview that I have. Who are you? Give us a little bit of an intro on your background, Michael.
Who am I? I like to end. Someone asked me, "Who am I?" I'm a child of God. That's the reflex response. But other than that, I'm 60 years old. I've been in the business for 33 years as a licensed professional. I was kicked off CNBC in the preamble. Actually, I guess it was like 2010, 2011 when they stopped having me on. But I was on all through the middle of that decade leading up to the global financial crisis. They needed a straw man that they could knock down. I said, this is going to be a big problem in the housing market. We're going to have a recession. I was shorting I was buying puts on Fannie Mae back then. And they said I was an idiot, and they all laughed at me. And then they threw me off. I think they threw me off. I don't know exactly the reason, but I think it's because I called the Fed a serial counterfeiter. I don't think they like that too much.
But hey, it's a badge of honor getting thrown off CNBC.
And I got to be honest with you, my career was moribund up until the point I got kicked off of mainstream financial media because, my IRA, I launched my IRA in 2012. And a few years after that, it just boomed in assets and it never went on another channel, Bloomberg, CNBC, even Fox News, Business News, or Fox News had me on again. Don't know exactly the reason, but maybe I'm just not their cup of tea. I don't like to be told what to say. I like to say the truth. I try to say the truth all the time, to the best of my knowledge, what is the truth. And sometimes it's not palatable to people who like to control you.
Yeah, or control the narrative
to
the public. Yeah. So what are you seeing in broad strokes on the economy right now? It's like a 70,000-foot view of the economy. What do you see out there?
Well, the economy is clearly slowing. If you look at retail sales data, if you look at housing data, if you look at the conditions that lead to weakening economy, like an inverted yield curve, we've got the deepest inversion. We had the deepest inversion, or one of the deepest versions ever, and the longest inversion on record. So the 210 inverted yield spread there.
Yep.
Financial conditions are still easy though. We still have credit spreads that are quiescent, and yet we see some cracks in the labor market. So it's early. It's a long time. I remember that. So go back before I got thrown off CNBC. It was 2008. They were asking me, well, you've been saying this for about a year now, that the housing market was going to be in a crisis, and the Fed raised rates to 5.25% back then, 2006. A year later, the market topped out in the summer or fall of 2007. That's when the S&P topped out. And then a year after that, the entire economy, financial market globally fell apart. Well, the Fed stopped raising rates last summer at 5.25%. And there are lag effects. I
Yep.
wouldn't be surprised if I wouldn't be surprised if the market topped out this summer. We see credit card, auto loans spiking, default spiking,
Delinquencies. Yep.
delinquency spiking. You see problems in the banking system. Commercial real estate is a huge problem. Maybe that's the subprime 2.0. But there's three bubbles that we have that exist concurrently. We've never had three bubbles before exist at the same time. We have a real estate bubble, a massive real estate bubble. We have an equity bubble, and we have a credit bubble. Before we had, in the year 2000, we had a NASDAQ bubble. It was just a bubble, not even a bubble in the equity market broadly. It was really a bubble in the NASDAQ. But that didn't stop the S&P from going down 50%. In 2008, we had a housing market bubble, and the equity bubble really wasn't that acute back then. But again, the S&P still went down 50%. But now, as I said, we have a credit bubble, bond bubble, equity bubble, and real estate bubble. Massive, unprecedented, all existing concurrently. And that's because we had 10 of the 14 years after the global financial crisis, we had interest rates that were near 0%. So less than 1% for 10, a whole decade. And that created massive distortions in the market. I mean, what do you do? What do you do when money is virtually free? You borrow it, right, Danny?
Yep.
And the government is insolvent now. We have a record amount of corporate debt as a percentage of GDP. Collateralized loan obligations, that number is through the roof. Private credit is in real trouble. Commercial real estate, mortgage-backed securities. We got major problems all over the place. And the only thing that's holding it together, I believe, is the amount of liquidity that was pumped into the system ex post the global the COVID crisis. With the reverse repo facility, which really is a parking place for banks' excess reserves, hit 2.5 trillion. Went down to 2.2 trillion. It was a spike to 2.5, but it really was 2.2. A year ago, it was $2.2 trillion of excess reserves. That money has poured out of the reverse repo facility. So think about it as reserves parked out of the financial system at the Fed, laying fallow, doing nothing but earning, interest. Credit, getting credit, Fed credit, getting credit. Then came out of the reverse repo facility, and the money market funds purchased bonds with that. And those bonds represented treasury bonds that were pouring money into the economy and used by Wall Street gamblers. You think like Roaring Kitty and, NVIDIA going up the market cap of Berkshire Hathaway in just a few days. So this is what we have. We have a stock market bubble, and I give you one statistic. So total market cap of equities as a percentage of GDP is 195%. That is unheard of and unprecedented. It just is, several standard deviations outside of the norm. The normal ratio here is like 70-80% total market cap equities to GDP. I'll give you one statistic. I'll give you another statistic. I'll give you a lot of them. So in 2007, it was 104% of GDP. In 2000, it was 140% of GDP. And before then, in the 80s and 90s, it was 70 or 80 for decades. It's just the total market cap of equities as a percentage of the economy should never be 190%. In fact, the top three companies, Apple, Microsoft, and NVIDIA, top three market cap of equities is more than a third of the entire U.S. GDP. Unheard of.
The Mag 3.
Talk about a narrow rally, and narrow rallies never end well.
Didn't we have a similar repo occurrence in 2019, right before the COVID crash?
We did, and that's we were entering even before COVID, the COVID outbreak, January, February of 20. The repo market was crashing already. Money market rates were spiking, and there was a lack of liquidity for treasury purchases. So that's why the Fed, you see, when you think about, well, why would Jerome Powell say, I am really, really anxious to start cutting interest rates because I think the inflation genie, or whatever they want to call it, the monster. Well, the Fed is the monster. That's the inflation monster. The inflation genie is monetizing government debt. That's how you get inflation. You destroy the market's confidence in a fiat currency. That's inflation. You can get it by a lot of ways or several ways, but the best way to do it is just to monetize debt. And we did that with the helicopter money, $6 trillion of helicopter money raining down on people. 4.5, 5 trillion of it was monetized by the Fed. So that's where you get your inflation from. But inflation has already destroyed the middle class. The lower three quintiles are broke. They're out of stimulus. So the only keeping the market holding up is all this money pouring out of the reverse repo facility. There's only $300 billion, 380 billion left. Only, I say only in quotes, but that's down from 2.2. So you've had about $1.7 trillion or so of QE in the past year. So that's what's holding the top two quintiles together. I mean, look, hey, I've got 5 houses. My real estate portfolio is doing great. My equity portfolio is doing wonderful. So I'll keep traveling to Europe. And that's what's making things look okay. But underneath the surface, most of the American middle class destroyed. Most of the stock market, by the way, has gone nowhere this year. The Russell 2000 is down negative on the year. The equal weight S&P 500 is up 4%. So, and that includes Nvidia, by the way, just those isn't overweighted. So most stocks are down. Most of the Americans have been wiped out. And that's when you poll people, they say, well, we're in a recession and in a bear market. It's because they are. Because they don't, what retirement portfolio, what fiduciary, you come in, they shake your hand. How you doing? What's going on? Well, I'm preparing for college and my wife's here. And, what's your financial plan? I'm going to do 100% Nvidia for you. Oh yeah. Nobody does that. So people own, most people in their portfolios, they own stocks and bonds. Well, bonds are down 4% this year. If you look at the TLT, the long duration bond, they're down. They were down this year. They were down last year, down the year before, and down by a lot. So if your portfolio is 100% Nvidia, you're doing fantastic. If it's a balanced portfolio with stocks and bonds, not so much. You're just doing okay.
Yeah. So you mentioned this.
I want to make this point. So I'm sorry to interrupt, Danny. Once the labor market really begins to melt down, and we're already seeing that happen. If you look at initial jobless claims, their 4-week moving average is the highest in September 2023. Continuing claims are up on the move too. Look at the household survey. I think we lost over 400,000 jobs last month. Lost 400,000 jobs.
Mm-hmm.
So there's a lot of other evidence that shows that the labor market is cracking outside of the non-farm payroll reports establishment survey number, the death birth model, which shows, hey, 270,000 jobs, net new jobs were created.
They're all part-time.
In May. No, they were all part-time. I mean, part-time jobs. The amount of full-time jobs, I think, is down.
Yeah.
Year over year. It's all part-time jobs, and the birth death model.
Yeah. So you mentioned this lowered rate environment that we've been in if you want to look all the way back to the 80s, this is the kind of mentality that the market has infused upon the investor. And now all of a sudden you have the fastest rate hiking cycle in history over the last 3 years, going from effectively 0 to 550 basis points Fed funds rate. The question is, you see the ECB, you see the BOC beginning to crack. You're beginning to see cracks in the walls in these central banks. The question is, how much longer can the Fed hold out before cutting rates? They changed their forecast just recently to indicate only one rate cut this year, no more than one rate cut. But the question really, it begs the question is, can they really hold out for one rate cut? Or as cliche and as trite as it may sound, until something breaks. Is that really, yeah.
Well, that's what they always do. I mean, the Fed was always late. Let's say the last time they went to an aggressive rate cutting cycle, not including COVID, they started cutting in the summer of 2007 when they had that Bear Stearns real estate fund, hedge fund blew up. And then from that point on, from the summer of 2007 to the end of 08, they went all the way down to 1%. Sorry, not to 0, 1%. So it was pretty aggressive, but it was too little, too late. This time around, the Fed is probably going to, I think the Fed will probably do the same thing. They'll probably cut around the margins once, maybe twice, depending on how bad the labor market gets, because they're labor market Phillips curve economists at the Fed. And the labor market is if you look at the non-farm payroll report, which they all focus on, that's a lagging economic indicator, but they're all focused on it. So that by definition, they're going to be late, as they always are. And they're going to be especially late this time because inflation is the big problem. I mean, if they aggressively ex ante started to cut rates right now, as Elizabeth Warren and crybabies on Wall Street are crying for, they did it right now. There's no guarantee that inflation would go down to 2%. I think it would most likely be guaranteed that it wouldn't go down. It would go up. The dollar would get crushed. Import prices would surge. Energy prices would rise. I don't know if the real estate market would really come down. So there's a chance interest rates would go up, especially long duration along the yield curve, out on the yield curve. But if they cut rates now, there's a chance that interest rates would go up, because they're cutting. If they cut rates now, the U.S. government for the first time in forever is insolvent by many metrics and many ways of looking at it. It's insolvent. You got $1 trillion in deficits, $1 trillion in interest on deficits, $2 trillion deficits. The debt is 725% of our income. We're adding 42% every year to the deficit, 42% of our revenue to the deficit. Think about that. Think about going to the bank and saying, I want a loan, and you're 700%. Your debt outstanding is 725% of your income, and not that you're saving money every year. You're adding to your debt by 42% of your income. No. They would kick you out of the door laughing, but that's the situation we have. So $2 trillion deficits, $1 trillion in interest. So you start cutting rates in that construct, interest rates might go up out on the yield curve. And then you also have the inflation problem. Like I said, I mean, inflation the rate of inflation has come down. The rate of change has come down from 9% to 3.3%, but that's not 2. And it's going up from a level that's already, the price level has already bankrupted 3/5 of consumers. So the fact that it's still going up more slowly but above target shouldn't be a reason to cut interest rates aggressively, right? I mean, that's common sense. So he'll probably cut once or twice this year, Powell, depending on the repo market and when that reverse repo facility runs dry. Could be problems before then, but he'll cut rates ex post when it's too late, and then we'll probably have a very significant recession because of the 3 triumvirate bubbles existing concurrently, and then the Fed's going to cut rates to ZERP, and then the Treasury and the Fed will be monetizing helicopter money once again, and probably is going to be a prescription for stagflation as far as the eye can see. That's what I think is going to happen.
How much stock can we give the inflation number, Michael? I mean, is it really at 3 some odd percentage points, or do you subscribe to a higher number?
Well, inflation is very subjective in the fact that, if you have a kid that goes to college and you're paying auto insurance and homeowners insurance, you have a different inflation rate than someone whose house is paid for and doesn't have any kids. So it's a question that I've asked myself often. Listen, the Fed isn't. You have to understand the government is in place of trying to underplay the inflation metric. That's what they want to do, because they want to limit they want to mollify the amount of money they pay on Social Security benefits. And they want to, of course, make the economy look better than when it really is. So they always downplay, and it's not my opinion. This is not like a conspiracy theory. They use hedonics and substitution. In other words, they say, if this grade of ground beef is up, well, you can always switch to another cheaper grade, or you can either stop eating meat or eat chicken. Well, that's kind of, and then they use something called hedonics to saying, well, the car went up in price, but the quality of the automobile has improved, hence there is no price increase. But when the package shrinks, or when something I call reverse hedonics happens, when you substitute a high quality protein diet for grass and dandelions, they don't count that as inflation. So they take out everything that's going up, and it's trim mean, and it's all this other. It's not my opinion. It's designed to undercalculate the rate of inflation. So the rate of inflation was 20%, not 9. 20%. We had a record high rate of inflation. If you calculated inflation the way they did before the Boskin Commission made the changes, then we, in the 80s and 90s, you would have seen inflation at around 20%, between 17 and 20%, not 9. So inflation is a big problem. It's caused the purchasing power of the middle class to be eviscerated, and I think it's going to get a lot worse.
What about using
because why is it going to get a lot worse? Why, Danny? Because the banking system, the Fed is in charge of keeping the banking system solvent. That is their primary charter. They can make, euphemisms about, well, I think the middle class is, the poor and the middle class and the minorities. They say all kinds of, they offer platitudes to these people, but at the end of the day, their charter is to keep the banking system solvent. So when a recession hits, and yes, the business cycle hasn't been repealed. When, not if, when the recession hits, we have these 3 bubbles. We're going to have private credit is going to blow up. CLOs, which are collateralized loan obligations, which are pooled loans to businesses who really have very poor credit ratings, they will blow up. The buy now, pay later programs will blow up. A lot of junk rated debt will blow up. It will be a lot of investment grade debt will become junk debt. So it's going to be a huge problem, and they're going to have to address it, because when you have those bubbles break, you're not going to have a mild recession where it's like a soft landing. No, you're going to have a recession that metastasizes into a depression. And I think they're going to have to go back to ZIRP and QE. And that's going to have massive ramifications for inflation.
What can the average person do to ensure that their bank won't follow the same fate as an SVB or a First Republic? Any things that people can ask their banks about, current that they can kind of get some insights on?
Well, I asked my bank about 2 years ago, or a year and a half ago. They were off my interest rate they offered me was 0.05%. And I said, well, I can get a T-bill at that time it was like 3.5%. And it's guaranteed by the full faith and credit of the US government. You are giving me only $250,000. I had more than that at the bank, $250,000 per account. And that's backed by FDIC. And that's only $250,000. So why would and I'm getting 0.05%. Why would I not move my money out of here? And he's like, I don't care what you do. No control. I said, all right, goodbye. And I took all my money out of my regional bank and moved it into money market funds, which own T-bills. Money market funds own strictly T-bills, not commercial paper or anything like that. That's the kind of fund I went into at the time. So that was with this mass exit of bank deposits from the regional banking system, which is in a lot of trouble. They've got like 30 or 40% of their assets. These smaller regional banks have 30 or 40% of their assets in commercial real estate. And the yield curve, as I said, is inverted. So their net interest margin is under pressure and their assets are eroding. Yeah, they're in a lot of trouble.
And doesn't the yield curve have to uninvert for a recession to follow suit?
Well, the uninversion of the yield curve always occurs when the Fed reacts after the recession is manifest to everybody. When the unemployment rate is spiking and the market is melting down, the Fed lowers interest rates, so they're taking down the Fed funds rate to close to zero, and that drops the yield curve from inversion to uninversion. So yeah, the long end will come down, but not quite as fast and as hard as the short end, and that's usually when. So that doesn't have to happen. That's a consequence of the recession and the Fed's reaction to it.
Okay.
Doesn't cause a recession. A yield curve that's normalized is a sign of a healthy banking system. But when it normalizes from an inversion, that is only because the recession has already
The other way around. Yeah. Yeah.
That even a deaf, dumb, and blind central banker understands the problem.
Okay. What about the price of gold? What about using the price of gold as a proxy for inflation? You're starting to see the price of gold tick up to new all-time highs. Well, it's not at an all-time high at this very moment, but it did break through 2450 about a month and a half ago. You're starting to see a tick up in the M2 money supply for the first time in, I don't know, 2 years or so. So are all signs kind of pointing towards a second wave of inflation in your mind?
Well, as I said, I think in the aftermath of the next recession, we're going to have stagflation like we've never before imagined.
Yep.
But I think the next sector, my investment spectrum called the inflation deflation economic cycle model that I created took me decades to develop. I launched it in 2016. Looks at the second derivative of inflation and growth. So I know where we are between recession and deflation and intractable inflation, sectors 1 to sector 5. I think our next sojourn is going to be in the sectors 2 or 1, which is, like I said, deflation and recession. And then you'll see the inflation coming, because I mean the price of gold is real money. So look at gold as measured in yen. It's going through the roof. Gold just exposes a fiat currency for all of its disgusting flaws, and we've abused our world reserve currency status for a very long time. I think gold is benefiting from many things, not only the fact that inflation has already destroyed the middle class, but it's also looking at countries around the world that want to get out of dollar hegemony. So, in other words, if the U.S. government deems you a bad actor and they confiscate your reserves, that's not a really good option for countries with currency reserve surpluses. Just parking their reserves in dollars and in treasuries isn't really a great option. What is a really good option for them is just to buy gold that they hold. So, that's out of the reach of the U.S. government. So that's what I believe is happening right now.
What's stopping a country like China or Russia from just adopting a gold standard on their currency and just exposing the dollar and every fiat currency surrounding it in the process? Like if I were Russia and I wanted to end the Ukraine war, wouldn't I just adopt a gold standard?
Well, maybe de facto they already are. I mean, not that these countries don't have problems of their own. China has a massive problem in their real estate market, and they're a communist nation with a horrific government. So I'm not going to say anything nice about China. But what I will say is their central bank, the PBOC, has been doing something very smart by buying a tremendous amount of gold. So maybe they didn't link the renminbi or the yuan to gold specifically, but by having so much gold, it gives more confidence in that currency.
And the petrodollar coming to an end this past week,
Yeah.
What does that portend to? Are they going to find a way to renew it, or is that simply all she wrote when it comes to the petrodollar?
I think that, look, I'm certainly not an expert in international currency affairs, so I don't know the mindset of every central bank, but I will tell you that the trend is inexorable to get out of dollars and diversify out of dollars. And that includes our other currencies and precious metals. That's a trend I see continuing.
Yeah. And I like to kind of rattle off this statistic every now and then on the show is that total global asset allocation. When you look at that, 1% of it is gold and gold equities. So a reversion to mean, which would be if you look at the 80s, it's 26%. It's the 70s, it's 30%. Even if you go from 1% to 5%,
Yeah,
that's a huge move in the gold price. Yeah, do
great.
you think it has that much elasticity?
It's a great point. Yeah, and there's plenty, and and there's plenty of gold to go around. It's just that the cost per ounce has to go much higher. And I think it will as a consequence of the macroeconomic condition that we have. I mean, we never before even ever dreamed in this country of having $1 trillion deficits, much less $1 trillion in interest payments in good times. Danny, we already have the national debt is 125% of GDP. I think we have about $35 trillion in debt outstanding. In the next recession, the annual deficit should be around $6 trillion. That's my prediction based on the predicate being past history of how much the deficit goes up in a recession. And you're having $2 trillion deficit in a soft landing, booming economy. That's what the mainstream financial media wants to tell us. It's a great economy right now, right? Certainly not a recession, but when a recession becomes manifest and the income dries up to the treasury and the automatic stabilizers kick in, you're going to go to $6 trillion, around that figure. And who the heck's going to buy it and at what price, what interest rate? That's the question. And that's why I'm very concerned. One of the main concerns I have about the next recession is that it's not an easy fix. Because the playbook is, hey, let's just take interest rates to 0% and borrow a bunch of money and everything's going to be okay. Well, you've done that since 1987, over and over and over again. And now you sit at a condition of insolvency and inflation that's very hard to control. I don't think inflation goes down to 2% anytime soon. I think it stays around 3% or higher.
Yeah.
And the only reason why it would go back to 2%, and the only reason why I would be wrong, or not wrong, inflation is going to be sticky around 3% unless and until we have a problem in the money markets, which is very possible, a high probability. And then you'll see inflation tank right alongside the economy.
Well, yeah, I mean, they've managed to make supply side inflation even worse with these higher interest rates. I mean, inadvertently, of course, because they'd raised the cost of capital. So you put more pressure on the supply side. It takes like $1 billion to build like an oil rig. Who's gonna finance that at 5.5% interest rate? So that just creates more of a bottleneck when it comes to these commodity prices. And then if they drop rates, then that creates more demand side pressure. So they're damned if they do, they're damned if they don't. That's kind of the conundrum of central planning.
Well, what they should do is here's a novel idea. No group of the 12 apostles at the Federal Open Market Committee that vote don't have any damn idea what the cost of money should be. There's no R star. There's nothing like that. The market knows what the cost of money should be based on the supply of money and the demand for credit. So supply of savings versus the demand for credit. That is the metric. And how do you control? And I had this argument with Steve Leisman on CNBC shortly before I got the boot. He goes, what? How would the Fed know? What's the base money supply? What should they be? Well, how about you just restrict it to having it grow commensurate with GDP growth or potential GDP growth, which is a function of labor force growth plus productivity. So how about 2%? That's probably the trend there. So 2%. So imagine if the Fed's balance sheet could only grow, which is high-powered money. It's the building blocks, the basis of all money supply. All aggregates come from the base money supply, which is Fed credit and physical currencies and coin in circulation. How about it's limited to 2%? Not where it goes from $4.5 trillion pre-COVID to $9 trillion, or $700 billion pre-global financial crisis to $9 trillion. How about that? Maybe that's why you have the inflation. No, not maybe. That's why you have the. That's
There you
exactly why
go.
you have. That's exactly why you have the bubble in Wall Street. And then when you have helicopter money, when you hand checks out to people and tell them you can't go out of your house because you'll die, you limit the supply side, and then you know what you get? You get runaway inflation, which is what we had. And if that's what they're going to do again, I wouldn't expect anything different. And in fact, I expect a lot worse because you already destroy the confidence in the monetary system of the United States. So keep it up. That's what they want to do.
Michael, thank you so much for coming on, man. Go ahead and drop us your socials. Where can people find you?
Well, the website is pentoport, P-O-R-T.com, pentoport.com. If you want my weekly missives, I have a reality check called the midweek reality check podcast. That's $50 per year. You get my thoughts. I'll give you the relevant economic data of the week that you should know and how I interpret it or objectively. Listening to this interview, you might think this guy's like massively short the stock market. I'm not. I have no shorts in the stock market. I have one short in the stock market. I'm short high yield. That's it. I manage funds for institutional clients and private clients. And I use the IDEC formula to manage that money. If you have $100,000 at least to minimum investment and you're a U.S. citizen, I will manage that money directly for you in that strategy, the IDEC strategy.
Fantastic. Any other thoughts you want to lay out there before we wrap things up?
Well, I think it's important. I'm not a Cassandra. I try not to use hyperbole, but I think it's important for these, dollar cost average, buy and hold, target date fund investors to understand that there are times when the market goes down. And if you have a viable, robust model, you can identify when those times are coming. Not when the market goes down 5% or 10% normal correction. The times when the market drops due to a recession, that's when the bad things really happen. That's when the market really crashes. And if you can identify that before it happens, instead of hearing like I did in 2007, 2008, oh, everything's fine. Everything's, you're just a Cassandra. You can identify when the recession is going to happen and when the liquidity crisis is going to happen. You can get out of harm's way and maybe try to protect and profit before the market goes down 30, 50, 80% like it has done in the past. And then people will say, well, you can't time the market. And they say the market always comes back. And I always point to what's going on in China. That market peaked in 2007, still significantly down. I think it's like down 40% or something since that. And then Japan, which peaked in 1989, and 35 years later, it's still down in nominal terms. Imagine telling somebody who's 35 that when they're 70, you might get even to where you were today. And we have this kind of, I think, based on the metrics that I look at and Warren Buffett looks at, it's called the Buffett indicator for a reason. It's not called the Pento indicator. We're in a massive bubble of the stock market. And it's not going to end. It's not going to end well. And it's not just that indicator. It's price to sales, median PE ratio. There's a lot of metrics that say this is a massive bubble. So bubble in credit, bubble in stocks, bubble in real estate. Just be careful. Just be on your toes. If you can have some flexibility, and I'm not saying maybe you move all your money to Pento portfolio strategies, but if you're in this, if you're in a S&P 500 target date fund and you think you're fine, maybe you move a portion of that money to a manager that can go long and short, move from bonds and cash into the stock market when it needs to be invested, and move out and back into protection and short the market. And where do you invest along the yield curve? What currencies, what commodities should you own and when to own them? That's what I try to do here at Pentoport. So thanks for having me on, Danny. I appreciate it.
Yeah, the pleasure's all mine. If you guys enjoyed this interview with Michael, right, go Michael, go in the comments. Also, don't forget to subscribe to the channel, hit that subscribe button, and Gold is money, guys. Be sure to check out our official gold dealer, Miles Franklin. Email them at info@milesfranklin.com. Tell them that Capital Cosm sent me in the subject line and get their special pricing sheet. And with that said, I will leave you with another episode. Done. All right, guys. I'll see you later. Bye.